Welcome back to Investing Talk Podcast.
Today we're looking at Navitas Semiconductor.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Okay, so we are jumping into a company that I think is at a really fascinating crossroads. Navitas Semiconductor. This is a story about a massive technological and strategic pivot happening right in the middle of this AI explosion.
That's the perfect way to frame it. I mean, Navitas is a leader in high-efficiency power semiconductors. So they're not making the big brainy chips, the GPUs.
Right, not the logic chips.
No. They make the critical components that manage the power flowing to those chips. It's the backbone. And their whole focus is on, gallium nitride GaN and silicon carbide SiC.
And these aren't just small improvements, are they?
Not at all. These technologies are fundamentally necessary for the kind of high-performance applications that demand extreme efficiency and speed.
And the big reason we're talking about them now is this deliberate choice they've made to sort of abandon their past.
Yes, they're actively stepping away from the low-margin, high-volume stuff. Think about, the standard little mobile chargers. That used to be a big chunk of their business.
And now they're chasing the big fish.
It's a classic move, right?
Yeah.
Shedding the old slow-growth baggage to chase these explosive new markets. They're going hard after the high-power, high-growth sectors.
Which are AI data centers, electric vehicles, and solar.
Exactly. Solar and grid infrastructure. This whole realignment, it's not just some marketing line. It is the absolute foundation for the entire bull case for this company.
Okay, so let's unpack the tech a bit. What's their moat? What makes their chips special enough to justify such an aggressive and, frankly, risky shift?
Well, the moat is pretty significant, and it's built on their own IP. The real standout is it's the world's first production release 650-volt bidirectional GaN integrated circuit.
That's a mouthful. What does that actually let a customer do?
It's a huge deal for system design. It lets their customers shift from what used to be a really complex two-stage power design to a much, much simpler single-stage design.
So why should an engineer or, an investor care about going from two stages to one? Is that really a big difference?
Oh, it changes everything, especially in a packed environment like a data center. When you cut out a whole stage of power conversion, you get three huge wins at once.
Okay, what are they?
One, you boost efficiency, which is critical when AI is so power hungry. Two, you use way fewer components so things get smaller and lighter. And three, you generate less heat.
And less heat in a data center is everything.
It's everything. For a huge hyperscale facility, that means massive savings on cooling and a big jump in reliability. It creates very high switching costs for any customer that designs their system around Navitas.
Got it. And what about the other side of their business, the SiC chips?
That's the other key pillar. They have an ultra-high voltage silicon carbide portfolio with chips rated up to 6.5 kilovolts.
That's not for your phone.
No. This is for the megawatt level stuff. We're talking high-power EV fast chargers on the highway, huge industrial motors, major grid upgrades. They're really covering the whole electrification spectrum.
Okay, so let's tie this all back to the biggest story right now, AI. We hear nonstop about GPUs, but where do these power chips fit into building out an AI factory?
They're absolutely vital. The next generation of GPU clusters are all moving to 800-volt plus power architectures. Your old-school silicon chips just can't handle that kind of heat and power density efficiently.
So Navitas chips are the enablers.
They're the foundation. They allow those high-voltage, high-current systems to work. If you're a hyperscaler building a new AI cluster, these efficient power chips are, they're non-negotiable.
The technology story sounds incredibly strong, which brings up the big obvious question.
I know where you're going with this.
If the tech is so great, why do the current financials look so ugly? We have to tackle this paradox right now.
Yep. You're right. We absolutely do. And that is the major short-term cloud hanging over the stock. Despite all this future potential, the company is in a period of severe financial contraction. We saw it in Q3 in 2025 when revenue dipped to just $10.1 million.
Just $10 million. And for the full fiscal year 2025, revenue was under $50 million? That's a drop of over 40% from the year before?
40.4%, yeah.
That's a huge drop. And they're still burning cash. The net loss over the last year is something like negative $125 million.
It is. But that is the direct consequence of the pivot we just talked about. A 40% revenue drop is, of course, alarming, but you have to see it as an intentional managed decline.
Intentional?
Yes. They chose to shed that old low-margin business. They knew revenues would crater before the new high-value contracts could ramp up.
Okay, so the argument is that this ugly contraction is masking something much bigger bubbling up underneath. What's the pro that's supposed to offset this pain?
The pro is the massive pipeline they've been building. Navitas has secured $450 million in what they call design wins.
So these are future contracts.
Exactly. It's a multi-year pipeline. And management says these wins are just now hitting the production ramp phase. They're calling this the inflection point, starting in the second half of 2025 and into 2026.
450 million is a huge number, but like you said, it's still just a promise on paper until the orders actually ship. How do we know this is high-quality business?
That's a great question. And the best clue we have is their margin stability. Think about it. Their revenue just fell off a cliff, down over 40%.
Right.
In almost any other hardware company, that would absolutely crush your gross margins. But Navitas's non-GAAP gross margins have stayed stable, right around 38 to 38.5%.
Okay, that is a really interesting operational tell. It means the new business they're bringing in has strong pricing power.
Precisely. They're not chasing volume by sacrificing profit. And that operational discipline is so important.
Because when the big AI and EV contracts start to flow,
That stable margin means operating leverage kicks in, and it kicks in fast. That's what will drive earnings growth.
and when do analysts think that happens? When does this story finally turn profitable?
The consensus seems to be that earnings will start accelerating around mid-2026, assuming the execution goes smoothly. They're projecting a revenue CGR of nearly 24% through 2028. And the big one, positive free cash flow is expected sometime in 2026.
But execution takes money. For a company that's still losing money, how's the balance sheet? Do they have enough cash to get to that inflection point?
They look pretty well capitalized for now. As of early 2025, they had about $75 million in cash. And with their operating losses narrowing a bit, that gives them a runway of over 6 quarters.
A year and a half? That's a decent cushion.
It's critical. It means they're not desperate for cash while they're trying to manage this complex ramp-up.
And they just shored that up even more with a big capital raise, didn't they?
They did. In November 2025, they pulled in another $100 million through a private placement. And that money is specifically earmarked for scaling their GaN tech to meet this new demand. It's a huge vote of internal confidence.
But maybe the biggest vote of confidence came from outside the company, with that Global Foundries partnership. Why was that so important?
That partnership announcement was a massive de-risking event, partnering with a giant like Global Foundries to accelerate U.S.-based GaN manufacturing. I mean, in today's world, that's huge.
Securing a domestic supply chain.
It's a massive competitive advantage. It tells big U.S. customers in the data center space that they can get reliable, high-volume supply without worrying about overseas volatility. It validates the entire roadmap.
So it's not just about getting more wafers, it's about credibility.
100%. It signals to every potential Tier 1 customer that Navitas is ready to scale securely and reliably.
Let's switch gears to the stock itself. How has the market been treating this story? With all the opportunity, but also all the short-term pain.
You know, it's been volatile, but the long-term trend has been overwhelmingly bullish. I mean, despite some recent pullbacks, the stock has more than doubled year to date, and it's up, over 390% year over year?
Wow, so investors are definitely focused on the future story.
They are. The market is clearly looking past the temporary revenue dip and focusing on that $450 million pipeline and the AI narrative.
And technically, where does it stand now?
The setup is pretty constructive for the medium term. The stock is trading above its 200-day simple moving average, which is a good long-term sign. And we've seen key support hold pretty firm around the $7 level.
So the stage is set. What's the near-term catalyst that could prove this whole thesis right?
The single most critical event is the upcoming full Q4 and fiscal year 2025 earnings report. That's probably coming in January or February 2026.
The moment of truth.
It really is. That report has to show two things. First, that the revenue bleeding has stopped. And second, some real hard evidence that the production ramp is starting to turn that huge pipeline into actual revenue.
And besides earnings, there's always the chance of a surprise announcement, right?
Absolutely. There's always chatter about new Tier 1 partnerships, especially in the AI space. A confirmed deal with a major hyperscaler or a big automotive company could provide a massive, immediate boost to the stock.
Okay, let's play devil's advocate. We have to lay out the risks, clearly. It sounds like the whole story hinges on one thing.
Execution.
Execution.
The execution risk here is paramount. That $450 million is still just paper promises. If that AI pivot fails to scale as planned, or if customers delay their own production ramps,
Then the whole timeline gets pushed out.
it gets pushed out, and that would put severe pressure on the stock's current valuation. It's the #1 risk.
And what about financial risk? They're funding all this growth with capital they don't generate internally yet. That means dilution.
That's the other side of the coin. That $100 million raise was necessary, but it came from issuing about 14.8 million new shares. These capital raises and stock-based compensation increase the share count, which can, cut into the slice of the pie for existing shareholders.
And finally, this is just not a stock for the faint of heart, is it?
No. It is extremely volatile. It has a high beta, around 3.1. What that means for you as an investor is that this stock overreacts to everything. If the market goes up, it can soar. But if the market pulls back, you are going to feel that pain amplified. It's high risk, high reward. So to wrap it all up, Navitas has done an amazing job positioning itself as a key technology for these huge trends in AI, EVs, and green energy. They have the tech. They have the big partnership with global foundries. The entire challenge now is just proving they can turn that tech-led and that huge pipeline into real accelerating revenue over the next year or so.
So the key question for you, the investor, is this. Does that global foundries deal and that $450 million in design wins mean the bottom is truly in? Are we watching this company transition from just a cool technology concept into a real live growth machine?
And make sure you subscribe and turn on notifications so you don't miss our next analysis.